What's up, everybody? How are you? It's Randy Wolfe. I thought a video I should shoot today is about how you can actually invest in real estate without having to do all the junk you don't really want to do, like dealing with tenants and toilets and contractors and all the things. So I actually just closed on a property a few moments ago, and I was going to kind of run through this property and use this property as kind of a case study and explain private money lending and kind of how that works, because you know, a lot of people, they don't have time to do what we do as active investors. You know, there's so much that goes into it. So many, I think, of the people who watch my channel are people who want to be active investors, and they want to actually, you know, do the thing. They want to market the deal, find the deals. They want to actually, if they're fixing and flipping, you know, they want to have their hands involved in that, or dealing with the contractors, or if they're rentals, manage or find property managers and then have them manage. But at the end of the day, there's a lot of people who just do not have the time, but they have money. Maybe they're high W-2 earners. They, you know, if that's you, keep watching this video, particularly because I'm going to kind of explain how this works, because I feel like when I talk to people, and a lot of our private money lenders that work with me and our company didn't really understand until I explained it to them. And so I figure, hey, I'm going to shoot a video and I'll just kind of tell everybody about it. And because of, you know, different regulations, and I'm going to use some of the numbers that I'm going to use are just sample numbers. If you are interested in becoming a private money lender with me, I'd love to have a conversation. We can talk about what it's like to work with us, and kind of go in depth on kind of returns and that sort of thing after we build a relationship. But here is this particular deal that I just closed on a few minutes ago. So the deal was, we're buying this property for $200,000. We're actually, it's going to be more of like what we kind of refer to as a wholesale. And that means that we were looking at doing a major renovation on this property, and this was going to be well over $100,000 renovation. And after just looking at the area, I just felt like this would be a better opportunity to do more of a wholesale. So we're going to go in, we're going to clean the property up. There is a pool that is just mangled. We're going to get that cleaned up and treated, and hopefully turn it from green to nice clear water. And then we're going to put it back on the market. We're going to sell it, or put it on the market. It was an off-market deal. And so the cost of the property to buy the home, we bought it for $200,000, and we're going to end up putting about $20,000 or so into just fixing some things, minor things, cleaning it up, and doing those things I just mentioned. So we got a loan for $223,400. That is what the loan is for. Now, if you were my private money lender on this deal, I'm going to explain and walk you through what it looks like so that you can understand, you know, how you could do this in a pretty passive way. We structure our private money lenders, for the most part, we structure as debt. And what that means is basically you get paid a set interest rate. There are situations where we will have deal partners, where we'll partner and do a deal together. And when you do something like that, there is, if we lose money, we lose money together. I've never lost money in a deal, knock on wood, never lost money in a deal. But like, if we did a deal together as deal partners, and the deal ended up, you know, we lost 10 grand and we're 50-50 partners, we would each lose $5,000 theoretically, right? Whereas we structure our private money lenders as debt. And so we pay a set interest rate. Now, the interest rate can vary wildly. Okay, I've heard of some people, you know, paying private money lenders, you know, as low as 6%. I've heard, you know, there's other situations where it may be up to 15%, or even some crazy situations where it's a real short period of time, maybe even a little more than that. All right, it just really depends. Basically, I'm going to use 10% because it's a nice round number, and we can make it simple with math. And so let's say that the return, you know, on your private money that you lend us, we agreed to 10%. Okay. The way that you calculate this, because it's simple interest, is you take the total loan and you multiply that times 10%. And then you divide that number by 12 to figure out what you would get paid on a monthly basis if you're receiving monthly payments. Now, a lot of times, well, let me back up. It kind of depends on the circumstances. If we have some of our investors, our private money lenders will lend money out of their self-directed IRAs. I have some other videos where I talk about how you can do this. But oftentimes when we get money from self-directed IRAs, that sort of thing, we'll just pay them back at the end of the project, because they're not using the cash flow because it's inside of their IRA. So a lot of times if we do that, we'll just pay it back at the end. If it's outside of an IRA, we'll usually give people the choice. Do you want to get it all lump sum, or do you want to get monthly payments? If you want to get the monthly payments, then as I said, you would take the loan amount, multiply that times the interest rate. So we're going to use 10% in this example, and divide by 12. And that is going to give you your monthly interest payment. Now, the difference between this and like a traditional mortgage, the way that that's calculated is, this is just interest only. So that principal amount is still owed to you, but the interest is paid out on a monthly basis. And so in this example, if you take $223,400 and you multiply that times 10%, the interest comes out to be $22,340 is the total amount of interest, okay? Then you divide that number by 12 to figure out what the monthly interest rate is, or interest paid to you is. And that would be $1,861.67. So basically, this project that we have here, we have a time frame, a projected time frame of 5 months. We're hoping to get in and out of this project in 5 months. I really hope we can get in and out quicker, but 5 months is kind of our projected time frame. Normally, with our investors, what I do is I have a 12-month period. If it's a situation where an investor needs shorter, depending on the deal, we could do that. But normally we do a 12-month term. But in this case, we're looking at probably being out of this deal in and out in 5 months. So if you look at that and you say, okay, $1,861.67 over the course of 5 months ends up equaling $9,308.33. That's what, as the investor or private money lender, that's what you would get over the course of that 5 months. Then whenever we sell the property, or if we keep it as a rental and we refinance the property, do like a cash out refinance is what we a lot of times will do, then at that point in time, either sell or refinance, you would get paid your entire principal amount back. So in this case, $223,400. So that kind of explains. So as you can imagine, if you have the capital, you could literally get involved with real estate and not have to do any renovations, not have to find any properties and spend money on marketing. We spend a lot of money on marketing to find deals. You wouldn't have to do any of that. You don't have to manage contractors. You don't have to deal with termites and toilets and tenants and all of those things. Now, if you want to do that, awesome. You can do that, and you have the opportunity as an active investor. You can make some huge returns. You can also lose money when you go that route too. But if you're interested in doing that, then that's great. I have a private community you can check out. First of all, be sure to like and subscribe to this channel, and then I have a private community where I teach new and aspiring real estate investors how to do that. But this video I decided to make more in line with people who might not necessarily want to do the active day-to-day because maybe they have a high W-2 job, and maybe being a private money lender might actually be a better fit for that person. You've got to make sure whenever you do this that you're protected. So there's some things that you need to ensure that happen. A couple things that we like to do. Number one is we have a promissory note that in South Carolina we use attorneys, so we have a promissory note drafted up, and then we also have a mortgage filed at the county, and this is to protect our private money lenders so that there's something actually recorded at the county level. The mortgage says, hey, if we don't perform, you can take the property back, and the promissory note just spells out everything in the agreement. So it's important that you at least have those two things, and anytime you look at becoming a private money lender, you want to make sure that you are protected in the transaction. And basically, when you have a mortgage like that, that just means, hey, if something happened and we didn't pay or defaulted or whatever, you as the private money lender would have the ability to take that property from us. And so again, it's a way to use the actual property as collateral against your loan. And this is exactly what banks do. In essence, when you're a private money lender, you're basically becoming the bank. That's what it boils down to. So you're acting as a bank. And at the end of the day, as you probably are very aware, banks make a lot of money by charging interest. And so as a private money lender, you're in a position to not have to be so active with things. You could have a job and do your thing and still be making money in real estate. I personally lend money. It's weird. I'm a private money lender and I'm an active investor that actually does the active stuff. So I have a self-directed IRA that I lend money out of to certain investors that I work with, and so I usually lend that money out, and then of course outside of my IRA I do my active stuff. So you can use an IRA, self-directed IRA, you can use a self-directed solo 401k. There's tons of things you can do that, you know, if you're thinking, well, I just don't have the money right now to do that, you might have it in a qualified account. So yeah, I wanted to shoot that video today. If you decide, if this makes sense to you and you're someone that's like, hey, I'm interested in learning more about how I can do this, feel free to reach out. I'll put in the description, I will put in there a Calendly link, and you're welcome to set up a call with me. We can talk more about it, and I can explain kind of how it works. And if it's something where you decide, hey, I'm interested in maybe working with you, then we can talk about that. You know, I like to obviously build relationships with the people that we work with and make sure you understand everything. And of course, we always use attorneys when we do this. And so I'm a big proponent of everything goes through an attorney to make sure and everyone's protected and that sort of thing. So if it's something you're interested in and you say, hey, I'd like to learn more about maybe what it's like to partner up with you, feel free to reach out. We can talk about what that looks like. But as always, I appreciate you watching today, and I look forward to seeing you on the next video.